Welcome to another session in the series of financial management. I am Dr. Neha Seth, working in the capacity of Associate Professor with School of Management Studies, Indira Gandhi National Open University, and today we are going to learn about working capital management. To start with, working capital, the meaning of working capital. What do we understand by this term working capital? It has two words, working and capital. That means capital that is working for us. There are two types of capital, one is fixed capital, another is working capital. We generally use this fixed capital for purchasing the fixed assets for the functioning of a firm, while we need working capital for its regular functioning, for its working, for its flow. That means the capital required for day-to-day operations of the business is known as working capital for us. The management of working capital is called working capital management. So, the focus of today's lecture will be on working capital management. That means management of funds that are required for day-to-day operations of the business. Going further, we will discuss the concept of working capital. As per the concept of working capital is divided into two parts. One is gross working capital, another is net working capital. This is something we have already studied in basic accountancy. Gross working capital. Gross working capital is nothing but it refers to the firm's total investment in current assets. That means when all the current assets are clubbed together, it is known as gross working capital. What are current assets? Current assets can be converted into cash within an accounting year or an operating cycle. So, any asset that can be easily convertible into cash in a specific time period, that is one accounting year or in one operating cycle, that particular type of asset is known as current asset. It includes cash, short-term securities, debtors, we may also call debtors as account receivables or bills receivables, and stock. And we need this these current assets to subset or to pay off the current liabilities as well. So, when we are in position to pay the current liabilities from current assets, the amount of current assets that is left with us is known as net working capital. So, net working capital refers to the difference between current assets and current liabilities. And what are current liabilities? These are those claims of outsiders which are expected to mature for payment within an accounting year, and it includes creditors, or we may call it account payables, bills payables, and any other outstanding expense. Net working capital can be positive or negative. Net working capital is positive when our current assets are more than current liabilities. That means we are clearly able to pay current liabilities out of our current assets. When we have positive net working capital, the firm is financially sound. That means the firm is able to pay off their current liabilities out of current assets. And after this payment, they are left with some amount of current assets with them for the regular functioning. While negative net working capital is a situation when our current assets are less than current liabilities. That means our current liabilities are more, whereas our current assets are less. That means we are not able to pay all the current liabilities from our current assets. And this situation shows there is some financial disturbance in the company. So, it is always preferred to have positive net working capital in the company. So, the gross working capital focuses on optimization of investments in current assets while financing of current assets, whereas net working capital focuses on liquidity position of the firm. It is a judicious mix of short-term and long-term financing. Now, why do we require working capital management? We understood what is working capital management, what is gross working capital and net working capital. But why do we need to manage this working capital? See, the level of investment should avoid two dangerous levels, that is excessive or inadequate investment. Excessive investment is a situation when we are excessively investing in the current assets. it affects the firm's profitability because the ideal investment earns nothing for us. So, there is no point of investing too much amount in our current assets. Whereas, when we have inadequate working capital, it impacts the firm's solvency. This is the situation when we are not able to meet our current obligations. So, that is why a finance manager should maintain an adequate amount of working capital. When we have studied this basic finance, we have studied the conventional rule, or I can say the ideal rule of managing working capital management, or ideal working capital that we need to manage, that is current assets should be twice the level of current liabilities. You might be remember that we have studied current ratio, and the formula for current ratio was current assets upon current liabilities, and ideal current ratio that we used to study was 2. That means our current assets should be twice as compared to the current liabilities. Now, suppose we have 2 rupees in current assets and 1 rupees of current liabilities. So, after paying current liabilities of rupees 1, we will left over with rupees 1 with us, and we may use this rupees 1 for our regular functioning of our firm. So, this is the ideal rule, this is the ideal situation that we should maintain in our firm for its proper working. Coming to another term, that is called operating cycle. Now, operating cycle is a time duration that is required to convert sales into cash after the conversion of resources into inventories. Or in a very simple language, if I will say, so when I will start from cash, I will start investing cash, and the circle will go on till the time I am receiving cash back. The time period that is used from investing cash and receiving cash is known as operating cycle. This can be understood with the help of this example or this diagram. In the beginning, I have cash. I have invested this cash, the funds, in purchasing raw material or some goods. Now, I converted this raw material into semi-finished goods, or I can say the finished goods, which is now known as inventory for me. Now, I will go to the market and sell this stock in the market. I will start selling, and after selling, it may be possible that I may get some amount immediately in the form of cash, and some amount that I may receive in future, that may be credit sale for me. I might create debtors in that case. So in this form, I will sell my inventory and I will be able to get my cash back. In fact, I will get cash as well as the profit earned over this sales. So, this process of starting from cash and earning that cash again in my hand, this process is known as operating cycle. Okay. So, the operating cycle of a manufacturing firm, for example, involves 3 phases. One is acquisition of resources, another is manufacture of the product, and third is sale of the product. So, the first step is that a manufacturing firm need to acquire the resources, whatever resources they require for the production. Then the next step is manufacturing, and third, once you have that finished good in your hand, the third is we need to go out in the market and we need to sell our product in order to earn revenue. The length of operating cycle of a manufacturing firm is combination of 2 phases or 2 periods, that is inventory conversion period. So, the time taken or time considered for converting raw material into finished good, and debt or receivable conversion period. So, once sales is made, specifically when the credit sales is made, the time period that is required from sales to get your money back or the funds back, right. So, inventory conversion period, it includes three things, that is raw material conversion period, work in progress conversion period, and finished good conversion period. Okay. While debtor conversion period is the time that is required to collect the outstanding amount from the customer. So, when these 2 time periods are combined, inventory conversion period and debtor conversion period, it will form a complete operating cycle for a manufacturing firm. There is another classification of working capital on the basis of its types. Okay. And according to the types of working capital is classified into 2 parts, that is permanent or fixed working capital or fluctuating or variable working capital. So, what is permanent or fixed working capital? So, it is a minimum level of current asset which is continuously required by a firm to carry on its business operations. So, it is a regular amount that you need to maintain, is the minimum amount we need to maintain to carry on our business. If we are falling below this level, that means it is a danger sign, we are not able to carry on our business operations smoothly. At the same time, we need some buffer or some extra working capital that may be required to support the changing production and sales activities of the firm. Suppose there is a seasonal demand, sometime demand is going up or sudden demand is there. So, just to cater such needs, we need fluctuating or variable working capital. Okay, so we should a good firm or a financial condition is considered to be stable when we are able to arrange these firms, these working capital, so that the functioning of our business will go on smoothly. Then we have certain determinants of working capital. There are certain factors which determines that how much working capital is required to be maintained in an organization. So, the first one in this is nature of business, the kind of business you are running. Okay, what is the nature of your business? It determines the working capital requirement. Suppose you are a service company, you are providing services. In that case, you don't need many of the fixed asset in your company for its functioning. In that case, the working capital requirement will be really high. Whereas if you are a manufacturing firm, in that case, you need huge investment in fixed assets. You need to purchase maybe building, factory, land or machinery for functioning of the business. In that case, your investment in fixed working capital, fixed asset will be really high. But as compared to your fixed investment, the requirement of working capital will be less. Okay, so nature of business decides the demand of working capital in your organization. Then the second is sales or demand condition. Okay, if the sale is going up, maybe because of seasonal demand or maybe some event happened because of which the sales or the demand condition is going up. So, if the demand is going up, obviously you need to produce more, and in case when you are producing more, you need more working capital. And suppose demand is less, if the demand is less, you need less working capital in that case. So, requirement of working capital also depends upon the sales or demand condition in the market. Then the third point is the business cycle. Business cycle is similar to the operating cycle. That means how much time you are taking to convert cash from cash to cash. If your business cycle is slow, that means you are taking lot of time to convert your sales into cash again. That in that case you need very high working capital because you need to function, you need to make your business function very smoothly. So, the working capital requirement will be really high. Okay, but if your business cycle is fast, you are immediately able to convert your finished goods into cash again. So, in that case your working capital requirement is less because you have that funds with you so that your business can run smoothly. Then the fourth thing is credit policy. What kind of credit policy are you following? How much time you are giving your debtors to pay off your funds back? Okay, if you are having liberal credit policy, that means you are giving lot of time to your buyers, the people who are purchasing from you, to pay the credit back. In that case, you need good amount of working capital to keep your business functional. But if you are following stringent credit policy, that means maybe you are not giving credit to your purchasers. Those who are buying from you, you are not giving them on credit, the sales is not happening on credit, or maybe the time period of credit is very less, maybe a week or 15 days. So, if you are taking less time or the policy is stringent in terms of giving credit, in that case the requirement of working capital may be less because you are getting your money immediately and you are able to use this money for functioning of your business. This is about the credit policy, the way you are giving credit. But at the same time, availability of credit also determines the requirement of working capital. Now, suppose you need immediate working capital or fluctuating working capital requirement is there. So, if the availability of credit is easy for you, you are able to arrange the credit immediately. In that case, there is no need to require very high amount of working capital. So, as and when the requirement arises, you can easily arrange the funds for you. But in case the availability of credit is not easy, In that case, you need to maintain working capital with you in good amount so that whenever the requirement is there, you are able to utilize those funds for your functioning. And the last point under determinants is operating efficiency. What do we understand by efficiency? Efficiency means whatever we are giving in the form of input and what we are getting as output. So, higher the output as compared to input, it is better for us because in that case the efficiency is very high. This is what a company wants to achieve, the higher efficiency. This is the method or this is the way how well you are able to utilize your resources. Okay, by giving less input, if you are able to generate high output, that means your efficiency is very high. So, how you are able to maintain your operating efficiency, your production level, this also determines that what is the requirement of your working capital. Okay, so these are the points that we generally keep in our mind while determining the requirement of working capital in our firm. Now, let us move ahead with working capital policies. So, a financial manager should determine the optimum level of current assets so that the wealth of shareholders is maximized. A firm needs fixed and current assets to support a particular level of output. Now, to support the same level of output, the firm can have different level of current assets. Okay. So, there is one thing called current asset to fixed asset ratio. Now, the level of current asset can be measured by the relative current asset to fixed asset ratio. That means, there is a ratio of current asset as compared to fixed asset. Now, if this ratio is high, if there is higher current asset to fixed asset ratio, that means a company is following conservative current asset policy. That means, company is taking steps very carefully. They are maintaining good amount of cash with them. So, in any contingency situation, any emergency situation, they are maintaining good amount with them so that they can face that situation easily. They are following conservative policy in that case. And in reverse situation, when this ratio is lower, that means lower current asset to fixed asset ratio is followed by the company. That means the company is following aggressive current asset policy. Okay, in that case, company is maintaining less current assets with them as compared to fixed asset because they are playing aggressively. So, whenever need is there, they might have plans in their mind that they will be able to arrange the cash whenever it is required. Okay. So, these policies on the basis of this current asset versus fixed asset ratio, there are three type of policies generally the firm is following. One is conservative policy, as I just now told you. So, this is the situation when greater liquidity is maintained and lower risk is taken, and this situation leads to low profit because we are not ready to take the risk, and when we are not ready to take the risk, the profit might be lower. This is the situation which uses long term or permanent capital to finance some temporary assets. So, your short term assets are financed by your long term capital. Okay. This conservative approach can be understood with the help of this example. You can see that on the lower part, on the lower section of this diagram, permanent current assets are maintained, and on the upper side of the diagram, temporary current assets are maintained. So, you can see the arrow which is on the right side of the screen, that there is up to a certain extent long term financing is there, but after a certain extent short term financing is there. But there is a little part of temporary current assets which are financed using long term sources. Okay, you can see the bigger arrow which is going little upper than the temporary current asset line. So, that means that portion of current assets are maintained by long term sources of finance. So, when this situation is there in the organization, the company is following conservative approach. But there is a policy or there is an approach which is absolutely opposite of conservative approach. We call it aggressive approach or aggressive policy. This is the situation when the liquidity is poorly maintained in the company or there is a poor liquidity in the company. In this case, the company is taking very high risk, and since the company is taking high risk, they will be able to earn high profit. So, this is the situation when they are using their short term or temporary capital to finance some permanent assets or fixed assets. The aggressive approach can also be understood with the help of this example. Like in previous case, the long-term asset arrow is going up to the permanent current asset line or to the temporary current asset line. Now in this case, you can see the arrow of short-term finances is coming down and reaching to the towards permanent current asset. It shows that some portion of short-term financing, that means some sources of short-term finance are utilized to purchase permanent current assets. Okay, so this is the case when the company is taking chance and they are using their short-term sources of finance to sponsor to purchase their permanent current assets. So when this situation is there in an organization, this is called an aggressive approach. And there is a situation which is somewhere in between of these two extreme, conservative and aggressive. We call it matching approach or matching policy. It matches the maturity of assets with the maturity of financing. So that means long-term finances are used to finance fixed and permanent assets, and short-term finances are used to finance temporary or variable assets. This matching approach can also be seen with the help of this diagram. Now you can see the long-term financing line or the arrow and short-term financing arrow. They are exactly meeting where the temporary current assets are starting. Okay, so it clearly shows that permanent current assets are clearly financed using long-term sources of finance, whereas the temporary current assets are used to finance finance using short-term sources of finance. So when this approach is followed, when long-term financing sources are used to purchase permanent current assets and short-term financing sources are used to purchase temporary current asset, that means the company is following matching approach, or this may also known as hedging approach. Okay. So the choice of working capital policy is a classic risk return trade-off example. It's a clear example of risk return trade-off when an investor is trying to balance between risk and return. The aggressive policy promises high return but carries greater risk as well. The conservative policy has the least risk but also the lowest expected return, whereas the moderate or matching, or we may also call it hedging approach, it falls between these two extremes. So this was the policies of working capital management. Moving ahead to the sources of this short-term credit. Okay, we will quickly have a glance over it. What are short-term sources of credit? So debt requiring repayment within 1 year are considered as short-term credit sources. The major sources of short-term credit are account payable, we may also call it trade credit, commercial papers or bank loans. Now what are trade credit? Trade credit is a credit furnished by a firm's supplier. It is often the largest source of short-term credit for small firms. It is spontaneous and relatively easy to get, but the cost can be very high in this case. Commercial papers, these are short-term notes issued by large and strong companies. It trades in the market at the rates just above treasury bills rate. Commercial papers are bought by banks and other companies and then held as marketable securities for liquidity purposes. And the third option of raising short-term funds is secured loan. So in a secured loan, the borrower pledges assets as collateral for the loan. That means something is kept as collateral for raising the loan. That is why it is known as secured loan. So for short-term loans, the most commonly pledged assets are receivables and inventories. So these were the sources from where we can raise the short-term funds. So till now we have covered what is working capital management, what are different concepts of working capital management, what are the determinants of working capital management, what are different policies which are followed in working capital management, and what are the sources of short-term credit that we may have.